You've heard the headlines about a 2026 income tax cut, and you're probably picturing a decent bump in your take-home pay. Here is the uncomfortable truth. For most workers, the rate cut itself is worth only about $268 a year. That is roughly $5 a week. But there is good news. Stick with me, because by the end of this video, you will know exactly how to turn that small cut into more than $1,000 a year using two things almost nobody is talking about. Let me show you where that number comes from. From the 1st of July 2026, the tax rate on income between $18,201 and $45,000 drops from 16 cents to 15 cents in the dollar. That is just 1 cent less per dollar on one slice of your income. If you earn $45,000 or more, that cut is capped at $268 a year. So the headline tax cut is real, but it is small, and knowing that protects you from over-planning your budget around money that is not really there. Here is why getting this right actually matters. People who overestimate the 2026 cut tend to underplan for the things that quietly eat into it, like the Medicare levy, help repayments, and bracket creep as wages rise. And on the other side, the workers who ignore the new instant deduction and the new offset can forgo around $455 a year in benefit. Over 20 years, that is roughly $9,100 in nominal terms, and a lot more if that money was invested. So a few minutes of understanding here is worth real money. Now you have probably also seen the bigger number, $2,816 a year. That is real too, but read the fine print. That figure is the maximum saving for an average earner from 5 separate measures combined, compared all the way back to the 2023-24 tax system. Most of that already arrived in 2024. With the Stage 3 changes, the part that actually changes in 2026 is small. So when a politician quotes thousands, they are usually adding up years of changes you have already received. Move 1 is to work out your real number rather than the headline. Log into MyGov, open ATO online services, and download your most recent Notice of Assessment. This shows your taxable income and the total tax you paid. This is your starting point. You cannot measure your saving until you know exactly what you're paying now. And almost everyone skips this step and just trusts the news instead. Now do the comparison. Take your taxable income and apply the new 2026-27 rate of 15 cents on the band between $18,201 and $45,000. Subtract that from your 2025 to 26 tax. If you earn above $45,000, you will land on about $268 a year, which is roughly $5.15 a week. If you earn less than $45,000, your saving is smaller because only the part of your income above $18,200 gets the cut. At $30,000, it is about $118. And there is a second cut worth knowing. From the 1st of July 2027, that same low band drops again from 15 cents to 14 cents in the dollar. For anyone above $45,000, that adds another $268 a year. So by 2027-28, the two rate cuts together are worth about $536 a year compared with 2025-26, or roughly $10.30 a week. Still automatic, still modest, but now you know the real figure to plan around. Move 2 is where the real upside hides. From the 1st of July 2026, there is a new instant deduction of up to $1,000. You can claim it without itemizing and without keeping receipts, but here is the catch people miss. It is a deduction, not a cash refund. It reduces your taxable income by $1,000, so the actual benefit is your marginal tax rate times that 1,000. At a 30% rate, that is $300 in your pocket. At 15%, it is $150. Treasury estimates an average benefit of $205 across 6.2 million workers. To make the most of it, plan ahead. In ATO Online, open your last return and list your usual work-related costs. Think home office expenses, tools, professional subscriptions, and professional development. Check they are genuinely work-related and that across the year they will reach or exceed $1,000. From the 1st of July 2026, keep basic evidence even though receipts are not required. And when you lodge, claim the full $1,000 instead of underclaiming out of habit. Done right, that is around $300 a year you would otherwise leave behind. Move 3 is the one most likely to be missed. From 2027-28, there is a new permanent working Australians tax offset worth $250 a year for more than 13 million workers. The key word is working. It applies to employment or sole trader income, lifting the effective tax-free threshold for work income by nearly $1,800 up to $19,985 or as high as $24,985 where the low income tax offset applies. People with investment-only income may not get the full amount, even though they heard $250 tax cut. To actually receive it, do a quick check. In ATO Online, make sure your main income is reported as salary, wages, or sole trader business income, not misclassified. Then from 2027-28, when you lodge, confirm the $250 offset shows up in your notice of assessment. If it is not there, review your income labels or ask the ATO or your tax agent why. If you are part-time or casual, make sure your annual work income is high enough to qualify for the full offset. Now let us put it all together with a real example. Sarah is a marketing manager in Sydney on $85,000, doing nothing extra. By 2027-28, she gets $536 from the 2 rate cuts, but at the full instant deduction at her 30% rate, that is about $300 at the $250 offset. Suddenly she is on about $1,086 a year instead of the $268 she would have had focusing only on the headline cut. That extra $550 a year, invested over 31 years at a real 4%, could grow to around $32,000. Before we recap, dodge these 3 common mistakes. First, do not assume the 2026 cut is worth thousands. The rate cut itself is about $268 a year. The bigger numbers add up years of past changes. Second, do not treat the instant deduction as a $1,000 refund. It is your marginal rate times 1,000, so $300 at 30%. Third, do not assume the $250 offset lands automatically for everyone. It needs work-derived income, so check your income is classified correctly. Let us run it back quickly. Step 1, log into MyGov, download your notice of assessment and work out your real saving, which is about $268 if you earn over $45,000. Step 2, plan your work expenses and claim the full $1,000 instant deduction from 2026. Step 3, make sure your income is work classified so the $250 offset reaches you from 2027-28. The rate cut alone is small, but used together, these tools can lift you to over $1,000 a year. So the 2026 tax cut is real, but the smart money is in the tools around it, the instant deduction and the offset, which together can be worth hundreds more every year. If this made the fine print clearer, hit subscribe, because next we are breaking down how to legally maximize your work-related deductions before the new rules kick in. Remember, this is general information only, not financial advice. See you in the next one.